Hello and welcome to this week's edition of The Week Ahead. Now, as countries put in more extreme measures to combat the spread of the coronavirus, how is this affecting the markets and what can we expect to see next? To find out more, let's speak to Bob Mason from FX Empire. Bob, thanks as always for joining us. It's an absolute pleasure to speak with you. We've experienced quite an extreme week, high volatility, a drop in the stock markets. Are you expecting to see something along the same lines in the next week?
After quite a week in the equity markets in Europe and the US and Asia last week, we're in for another big week ahead. The narrative's not changing, the coronavirus continues to spread and the volatility is going to persist. The real question is where the floor is. US markets hit levels not seen since 1987, in terms of daily drops, and European markets saw the largest falls on record on Thursday alone. Markets are in bearish territory. The US government showed its inept approach towards the spread of the coronavirus. Containment measures should have been introduced earlier. Blaming the Europeans on the spread of the virus across the US is probably the worst thing that Trump could have done going into the presidential race this year. Looks like he's really written off his chances of a second term. And that's another thing the market's going to have to consider once we see the dust settle from the coronavirus spread that isn't looking to settle anytime soon, to be honest. So next week, we've got the Fed in action, and really the FOMC economic projections are going to be particularly telling in terms of how the Fed sees the virus playing out on the US economy and on interest rates and inflation. Obviously, any marked deterioration in forecast for employment, and that's another a thorn in Trump's side and could be the final nail in the coffin. So yeah, plenty of volatility to come. Obviously, markets going to be looking towards February, March economic indicators to see and assess the damage of the coronavirus on Europe and the US. For Europe and the US, it's really going to be March numbers that are going to be the telling tale, and Philly Fed manufacturing numbers and New York Empire State manufacturing index figures in the week will be the first signs of what impact the virus has had. We're expecting shutdown mode across EU member states, even the likes of Britain, possibly, and US member states should this spread continue. So yeah, that's hardly going to support upward momentum in the global financial markets, so volatility will persist.
The central bank's upcoming actions and coronavirus fears are the major focus for the currency pair traders. What about the commodity pairs?
For the commodity currencies, the pain's yet to abate, and we're going to see more pain to come. For the Aussie dollar and Kiwi dollar, we saw some upside in the open Friday at the end of last week. The upside is unlikely to be long-term, however, and there's more downside risk to come. Obviously, we're looking at the world's largest economy in a state of flux as the coronavirus spreads, and that's only going to have downside effects on the global economy and demand for commodities, and obviously that's going to weigh on commodity currencies. Fed's obviously expected to deliver another rate cut next week, but that's not going to mean material upside for the Aussie dollars and the Kiwi dollars. Obviously, the RBN, AUDNZD are also under the hammer now to provide support, so there could be more downside on the monetary policy front, and I would expect the RBA to deliver another rate cut, in particular when you consider the fact that obviously China's economy is not going to rebound anytime soon. RBNZ's been obviously quiet until now, but that's likely to change as well. So on the economic data front next week, it's only really the Aussie dollar in action with employment figures for February due out. Has the Chinese meltdown had an immediate impact on the Australian economy and employment? We're about to find out, and obviously that's going to be a telling sign of what's to come for the RBA next month. For the loonie, obviously an extended price war between OPEC, Russia and the US. That doesn't bode well, and obviously risk aversion is plaguing the loonie already. With the Fed delivering rate cuts, the BOC is only going to have to follow suit. So 140 levels against the greenback are expected. We're almost there, and obviously we can see the Aussie dollar and Kiwi falling back to levels seen earlier in the week last week as well. So plenty of volatility, plenty of monetary policy action, and obviously there's government support to come as well, but none of that is really considered to be material until the fallout from the coronavirus has been quantified, and we're nowhere near that stage yet.
Elsewhere, Bob, what do you think about the major Asian pairs, be it the yen or the yuan?
The Asian currencies, the two biggies, the Japanese yen, well, we've seen it hit 102 levels last week. Risk aversion driving demand for the yen. Obviously, we'd seen the yen take a tumble in recent weeks due to the spread of the coronavirus and the impact on the Japanese economy. Now that the US is becoming a victim of the virus as well, and obviously the economy is expected to take a hit, we got the yen status back as a safe haven. It's been bouncing around though, so returning to 105 levels, but I'd say the downside for the yen is probably quite limited, and we can see a return, heading towards 100 against the greenback is a plausible move should the spread of the coronavirus continue across the US and the US need to take more severe measures to contain the spread of the virus. Monetary policy action next week, obviously we've got the BOJ in action. They're expected to deliver something. How much wriggle room they have, well, we know that's very little because they've been promising a move throughout all of last year and yet to make one. Their hands are tied this time, so they're going to have to deliver something. They might follow the ECB's path, however, look to support lending to businesses and obviously the consumer to try and crank up spending. But with the sales tax rate hikes from last year, consumers are not really that interested in spending money anyway. And how much impact does that have? So really, I would point to more upside for the Japanese yen. Looking at the yuan, obviously it's under pressure. We've seen it fall back to 7 levels against the greenback. The Chinese economy could be the first to begin recovering from the spread of the coronavirus, but obviously that's reliant upon global demand. And as the spread continues across the West, that global demand is unlikely to be material to actually support. So the Chinese government is looking to crank up demand domestically, shutting down global tourism, and obviously trying to get the consumer to spend onshore. How much influence that has as the virus continues to linger remains to be seen, though. Obviously, we don't know whether the numbers coming out of China on the pace of contraction of the virus are actually accurate or not. The numbers will tell. First set of numbers out next week. Obviously, industrial production, retail sales figures out of China, those will be particularly interesting for the markets, and that could set the tone for the week once more.
So it's quite obvious now, Bob, that the main focus next week will be the coronavirus fears. What about other fundamentals that you're looking at?
On the fundamentals, we've seen the markets largely brush aside economic data of late. That's really because December, January numbers are of little interest and don't reflect the effects of the coronavirus and China's shutdown in February, and obviously the effects going across through to the West in March. So we're now getting into that period where we're seeing February, March numbers begin to trickle through, and that's going to have a material impact on the G7 currencies and obviously the emerging markets. Any dire numbers from February onwards, and we're expecting more to come in March, April. We're not going to see rebounds at the start of the second quarter. We're end of first quarter now, and the West is only really starting to feel the pain. So expect economic indicators to begin to take effect. Trade data out of Japan, industrial production and retail sales figures out of China, and manufacturing numbers out of the US, I would say are the main indicators to look out for. Obviously, we've got the Fed on Wednesday. Their economic projections are going to be particularly telling. Any dire outlook on growth for 2020, and then obviously we're going to be expecting some more stress in the global financial markets. Equity markets has already borne the brunt. The dollar's been under the hammer, as have the commodity currencies. The euro and the yen through carry trade unwinds have been on the upside, but obviously the economic indicators are going to begin to stress those currencies as well, particularly the euro, as we expect economic indicators to point to a meltdown really going into the second quarter. So fundamentals will start taking effect through next week, with China setting the tone at the start of the week with their production and retail sales figures.
Well, Bob, thank you so much for speaking with us. It's always a pleasure. Take care of yourself. Thank you for watching, everyone. We'll see you next week.